Okay, let's unpack this. We're talking about arguably the most complex and expensive economic project Europe has undertaken.
The energy transition.
The multi-decade energy transition. It involves building entirely new infrastructure, integrating volatile resources, and, fundamentally reshaping grids across dozens of countries.
It's massive, and critically, energy assets are. They're unique. They demand an extended investment timeline, think 20 to 30 years.
Right.
That involves initial high-risk development, a long operational phase, and eventually expensive repowering or decommissioning. You just can't finance that with a standard 5-year private equity fund.
So the financial architecture has to be just as robust and long-term as the wind turbines and solar parks themselves. And that's our mission today, really.
Exactly.
To explore the sophisticated mechanism that institutional capital prefers for this exact challenge. The Energy Fund, S.C.A, SICAV, or RAIF, domiciled in Luxembourg.
We're extracting the essential knowledge on why this vehicle combines the legal stability of a traditional company structure with the operational flexibility and formidable tax efficiency needed to manage assets across multiple EU jurisdictions.
And Luxembourg is clearly the foundation for this. I mean, why is this one jurisdiction such a powerhouse, especially when the actual assets, the solar panels, the biogas plants, are located everywhere else?
Well, it really comes down to consistency and the depth of the ecosystem there.
Okay.
Luxembourg offers a few key advantages. First, a stable legal and political system, which really matters when you're committing billions for 25 years.
Sure, you need that certainty.
And second, it has a massive, highly skilled fund service ecosystem. We're talking administrators, lawyers, auditors who specialize in these cross-border SPV networks.
And what about the regulatory side?
That's the final piece. Its fund regimes align perfectly with the AIFMD, the Alternative Investment Fund Managers Directive.
Ah, and that's the key to EU-wide access.
That's your passport for smooth EU-wide fundraising and market access.
Okay, so if we connect this to the bigger picture, where is the money actually going? Because the energy transition isn't just one monolithic project, right?
Not at all.
Our research showed the needs in the Nordics look nothing like the needs in the Mediterranean.
That diversification is crucial. And the funds using this structure are investing across the entire spectrum. For example, in Germany, the capital is often focused on wind repowering projects and those high-stakes hydrogen pilot schemes. Meanwhile, down in Spain, we see a focus on massive hybrid parks.
So that's pairing solar with battery storage.
Exactly. Utility-scale solar PV with battery storage solutions.
And there were some even more niche areas, weren't there? I was fascinated by the mention of agrivoltaics in Italy.
Yes, that's a huge emerging field.
The whole concept of solar panels sharing space with farming operations. And France focusing on biomethane. It just underscores the complexity the fund has to manage.
It does. And that complexity is managed through the corporate structure itself, which combines company law, known as the S.C.A., with the specific investment vehicle legislation, the RAIF.
Okay, let's start with the S.C.A. Why is that part so critical for these long-term infrastructure plays? It sounds like a lot of legal jargon just to manage a wind farm.
I mean, it sounds like it, but the S.C.A. is fundamentally about stable control.
Stable control.
It clearly delineates the roles. You have the general partner, the GP, who provides a tiny bit of capital but retains full centralized management authority and strategic control.
And then the investors.
Then you have the limited shareholders, the big institutions, who supply the vast bulk of the capital but benefit from limited liability.
So why is that centralized control so important for energy assets specifically?
Because of the timeline. Imagine you're 20 years into a project's life.
Okay.
You need to decide whether to repower the site with newer turbine technology or sell the asset entirely if you use a more typical corporate structure.
You'd need everyone to agree.
Exactly. You might require unanimous or supermajority shareholder consent, and you risk governance deadlock. The S.C.A. prevents activist investors or minor shareholders from disrupting a necessary 25-year strategy. It ensures continuity.
Right. That locks down the stability. But stability often means slowness. How does the other half of this equation, the RAIF, the Reserved Alternative Investment Fund, bring the speed you need to capture these deals?
That's the regulatory genius of this structure. The RAIF regime is the engine that allows for rapid deployment.
How so?
Its biggest structural advantage is that it doesn't require direct approval from the CSSF, which is Luxembourg's financial regulator. Instead, it relies on oversight from an authorized AIFM.
And what does that regulatory shortcut mean in real terms for a fund manager trying to lock down a project?
We're talking about cutting regulatory launch time from many months, maybe 6 or 9 months, down to a matter of weeks. When you're bidding on shovel-ready energy projects across Europe, that speed to market is critical for deal capture. You get institutional rigor because you still follow the European directive, but without that bureaucratic lockup time.
Okay, here's where it gets really interesting for me. The flexibility. We've established the AIFM is kind of the internal regulator supervising all the governance standards. But how does it deal with the specifics of complex cross-border energy revenue?
That's where the administrative complexity skyrockets and why the AIFM and the depository are so crucial.
Right.
The AIFM enforces risk management, ensures consistent valuation policies, which is hard, with volatile power prices, and monitors leverage limits. For assets held in hundreds of scattered special-purpose vehicles, the oversight is just immense.
And the depository is the ultimate watchdog in all this, right? They have to reconcile cash flows coming from incredibly diverse sources.
Think about it. An infrastructure fund isn't just selling power on a wholesale market. The revenue streams are layered. You have income from long-term corporate power purchase agreements, or PPAs. You have revenue from capacity markets, and you have various feed-in tariffs or premiums, FITs or FIPs, dictated by local governments in Italy, Germany, Spain.
All with different rules and risks.
All with different tenors and regulatory risks. The depository is tasked with monitoring the flow of every single euro to ensure compliance and proper safekeeping. It's a hugely specialized task.
Okay, let's talk about that ring fencing mechanism. The source material really emphasized the power of compartment flexibility within the SICAV structure. Why is that ability to separate assets so fundamental?
Because it allows for risk mitigation that you just can't get in a standard single pool fund. Think of the SICAV as one massive vault.
Okay.
When the compartments are separate, lock safes within that vault. This framework lets the sponsor isolate risk along, say, 3 dimensions: technology, country, or development stage.
So wait, if I have one compartment dedicated to a high-risk hydrogen pilot project in Germany, and that project goes bankrupt,
The failure or legal liability of that high-risk compartment cannot legally touch the assets held in a separate compartment, say, your operational, stable wind farm portfolio in the Nordics.
I see.
The assets and liabilities are strictly ring-fenced. This is essential for attracting conservative investors like pension funds who might be comfortable with the steady yield of the wind compartment, but would never touch high-risk development capital.
But doesn't that intense compartmentalization just introduce, I don't know, administrative hell? It sounds incredibly complex to run.
It absolutely increases administrative requirements, which is why that ecosystem in Luxembourg is so key. But the cost is outweighed by the ability to tailor investment strategies.
And it has other benefits too, right?
For sure. If a fund actively promotes environmental characteristics and uses that ring fencing for green assets, they can qualify for SFDR Article 8 classification. That stamp of approval is now non-negotiable for attracting massive ESG-focused capital.
Makes sense. Let's shift now to the efficiency factors, specifically tax. What is the fundamental, almost existential benefit for these multi-decade investments when a RAIF adopts the SIF tax regime?
The benefits are substantial because they're designed to solve that perennial double taxation problem that plagues cross-border holdings.
Okay.
At the fund level, adopting the SIF tax regime brings exemption from 3 critical taxes: corporate income tax, municipal business tax, and net wealth tax.
That's a powerful set of exemptions, but why is it existential for a 25-year asset?
Because if the main fund vehicle were subject to standard corporate tax, the profits generated from the underlying assets, which have already paid tax locally in Spain or Italy, would be taxed again when they flow up to the fund.
Double dipping.
This structure essentially makes the fund tax neutral, like a pass-through. The only tax paid at the fund level is a minimal 0.01% subscription tax on the fund's net asset value. That efficiency maximizes capital returns over that long horizon.
Right. It avoids the friction. But the physical assets are still held in local SPVs operating under national tax laws. How does Luxembourg help those subsidiaries manage tax leakage?
This is where Luxembourg's centralized location is leveraged. The Luxembourg SPVs sit at the nexus of a comprehensive double tax treaty network.
Okay.
When dividends or interest payments flow between the local SPV in Italy and the Luxembourg fund, those treaties help reduce or eliminate withholding taxes. Clear transfer pricing rules also provide certainty. The whole framework is vital for minimizing that tax leakage.
We mentioned financing flexibility earlier. The research showed the fund can invest using equity, preferred equity, mezzanine debt, a whole menu of options. How does that tie back into the risk compartmentalization we just discussed?
It's highly synergistic.
Hmm.
Because you can legally ring-fence your assets by risk profile, you can attract different types of capital for different compartments.
So you can match the money to the risk.
Exactly. For instance, the compartment holding stable, operational solar farms can be heavily financed with senior debt, attracting conservative banks or debt-only investors who demand low risk.
While the separate compartment for, say, development stage offshore wind, which is much higher risk.
Can attract the expensive, high-risk development capital and pure equity investors. You perfectly match the capital source to the project risk, optimizing the fund's overall cost of capital. You couldn't do that if all the assets were just pooled together.
Okay, let's get serious about risk. What are the core regulatory and operational risks these projects constantly face, and how does this structure help mitigate them?
The sources outline 3 major categories of risk that have to be in the offering memorandum. First is political and regulatory risk.
Right. Subsidy changes, things like that.
Exactly. Sudden subsidy changes by local governments, or perhaps more common, just crushing permitting delays which can hold up construction for years.
So how does the structure mitigate that?
Primarily through diversification and that ring fencing. If political risk materializes in country A, the fact that that asset is ring-fenced means it doesn't taint the entire fund. The manager can isolate the problem.
And the second risk?
Second, you have construction and supply chain risk. Delays, material shortages, cost overruns. The financing flexibility allows managers to quickly inject development capital or bridge loans to keep projects on track.
Then
Finally, operational and resource risk. The risk that the sun doesn't shine or the wind doesn't blow as projected. This is mitigated through high-level asset management, but the structure provides the long-term stable platform you need to ride out those multi-year volatilities without being forced into a fire sale.
So wrapping this up, what does this all mean for the actual strategic use cases? Who is the ideal client using this highly specialized vehicle?
Well, a platform is tailor-made for serious long-term capital. We're primarily looking at institutions like massive pension funds and insurance companies.
Why them specifically?
They value the transparent, AIFMD-compliant governance and the efficient multi-jurisdiction exposure because it helps them match their long-term liabilities.
Makes sense. What about other key players?
Family offices are very attracted by the long-term stable returns and the integrated ESG focus. And critically, private equity sponsors use the RAI structure for fast deployment of development capital and for structuring co-investment deals.
And finally, after decades of holding these assets, how does this structure facilitate a smooth and efficient exit?
The exit mechanism is really the clean close of the cycle. The fund structure enhances exit efficiency in a few ways. First, you can sell off the entire diversified portfolio to a larger infrastructure fund.
Okay.
Second, you have the flexibility to sell isolated compartments. So you can sell specific ring-fence assets without disrupting the rest of the fund. And third, the critical financial detail.
Let me guess, a tax benefit.
You got it. The REIF is exempt from capital gains tax upon the final disposition of the fund's assets.
That capital gains exemption, paired with the other tax exemptions, truly solidifies its position as the go-to vehicle for this.
Precisely. The Energy Fund S.C.A. SICAV RAIF offers a durable, robust platform. It combines the governance stability of the S.C.A. with the rapid deployment and regulatory discipline of the RAIF regime, making it uniquely suited for the demands of the European energy transition.
That wraps up our deep dive into the financial architecture powering Europe's green revolution. We've seen how flexibility is built into the structure via ring-fenced compartments. We also noted the fund uses incredibly diverse financing models, including high-risk equity and low-risk senior debt. So consider this. How might the specific segregation of high-risk hydrogen pilot projects, which need that expensive development capital, from stable operational wind assets, which carry senior debt, fundamentally change how future institutional investors allocate capital based on highly specific, granular risk tolerances? That's something to chew on as this all matures.